Hi, you're watching ET Markets Live. I'm Neha Vashi. Welcome to a brand new episode of ET Smart Investor, where we discuss all about your investments and much more. Today, I'm here with Mr. Chirag Muni. He's the Executive Director at Anand Rathi Wealth Limited. Thank you so much, Chirag, for joining us today on ET Markets.
Thank you, Neha.
The pleasure is all mine. So let's quickly start our session for today. And for people who are joining us right now, let's also talk about the topic of the day, which is about information ratio. Now, in today's session, we are going to decode what exactly is information ratio, how is it important, and why it matters. So let's start with the basics, Chirag. What exactly is information ratio? It's not something that a lot of investors are aware about. Could you explain it in a very simple manner?
Yes, Neha, thank you so much. I think firstly, kudos to you. I think you're taking such important topics, often ignored, very important concepts, which we need to know, at least
Mm,
as an investor. And so thank you for that, for taking this topic. Yeah, coming to what is the information ratio? It
mm,
is, it is a ratio which actually gives you the ability to assess a fund manager of how he's giving the excess return over and above benchmark, keeping in mind the
mm,
risk taken. So, generally when we look at funds, for example, let's say a fund has given 15% return and its benchmark is given 11% return or 12% return,
mm,
let's say, which means that 3% excess return that is given, which is good. Obviously, we are investing in active fund management to get that additional excess return. But how much risk it has taken this compared to its benchmark is what the information ratio will tell you. So the higher the information ratio, the better is the risk adjusted return
okay.
for the investor. So let me give you an example. If in the same category, let's say if I have a large cap category and I have two fund
Mm,
managers who are, let's say, giving the same return 15%, and they have the same benchmark of, let's say, 12%. So which means both have given 3% extra. So which fund manager should I choose? So if you calculate the information ratio, which also takes into account the tracking error, which is the standard deviation, and the risk,
mm,
it'll if the higher the positive the information ratio of the fund manager, you have to choose that fund manager rather than
okay.
the fund manager is giving the same return. However, one fund manager has taken lesser risk to give that excess return over benchmark compared to fund manager B, who has given the same return but slightly taken a
Mm.
higher risk. So that's why this information ratio clearly distinguishes between how consistent is the fund manager and how much less risk is taking to generate that additional return.
All right. Let's also talk about how do you see the information ratio reshaping the way investors assess fund manager performance, especially when we talk about an era where, passive investing is gaining ground.
So there are two questions to it actually, Neha. One is, should we really do active fund management, or should we, because like you said, passive fund management is also becoming very, very popular.
Mm, yeah.
But to our mind, when we analyzed last 5 years of all the categories of mutual funds, the regular ones which we generally invest into, whether it's large cap, large and mid cap, flexi cap,
Mm,
focused, multi cap, contra, so on and so forth. If you see most of them, barring the large cap category, 60 to 80% or 100% of them have able to beat Nifty, number one. And
mm, mm,
most of them, 70% of them have been able to beat their own benchmarks. So, which means that if you're able to choose the right funds, it is always better to go with an active strategy rather than a passive strategy, because a passive strategy cannot give you that excess return. It will just mirror your benchmark, right? So,
mm,
firstly, you need to understand that excess return is possible still. While passive, there is some marketing around passive management going on, but in India, I think still there's a long way to go in terms of only investing into index funds. Number one.
right.
Number two is, now within that, of course, if you choose the fund manager's active strategy, now which are the funds who are giving you excess returns? A, and within the
Mm,
excess returns, which are the fund managers who are taking lesser risk to give you that excess return? So that is something that information ratio will kind of help you to evaluate, and then you will be able to make a better choice in terms of going with which fund, rather than just going basis past performance or only the excess returns. because the risk factor is also very important to look into the picture.
Okay. Before we move to how to assess information ratio, let's also briefly talk about why information ratio matters and how they're different when it comes to other ratios that are out there.
Like I said, so for example, the most other popular ratio that people use is called Sharpe ratio, which
Hmm.
is nothing returns minus the risk-free rate divided by the standard deviation, which means that it takes into account the volatility. However,
Hmm.
it measures itself to a risk-free rate, which is the government of India rate, for example, 6.5%. But the information ratio is a more applicable one because it also compares itself to its own benchmark. So one is
Hmm.
Sharpe ratio is actually looking at risk-free rate, whereas information ratio is more looking at its own benchmark, that to beat my own benchmark, how much risk have I taken? So that's how this information
Hmm.
ratio is slightly more important. I'm not saying that that is the only parameter, but that's the difference. There are of course other parameters like beta, Sortino ratios, which we will discuss. But the point I'm
Yeah.
making is this is a clear distinction of comparing itself to the benchmark and how much risk it is taking.
All right. Now, given the limitations of both short-term and long-term performance windows, what do you think is the preferred time horizon for evaluating IR ratio and why?
So very pertinent question here. Actually, you need to look at it in perspective, the information ratio. If you take very
Hmm.
short periods, then that can
Hmm.
also, skew your decision making, because in short periods, there are a lot of movements. There can be negative excess returns. I mean, negative returns over and above the benchmark, or there can be, a lot of volatility. So these short term
Yeah.
periods can kind of, little bit skew your decisions, number one.
Hmm.
Or a very long term period is also, like a 10-year period is not required to look at information ratio, because the strategy itself would have gone so much of changes within the fund
Hmm.
itself, or the fund manager himself has changed 2 3 times. So a 10-year period also may not be the right. The ideal period to our mind will be a 3-year or a 5-year period to see consistently how's the information ratio being. Like I said, a more positive information ratio in a 3-year scenario
Hmm.
uh, would be more relevant. And that fund manager should be picked over a fund manager who has a slightly lesser information ratio.
All right. I've gone through some data and I noticed that multi-cap and contra funds have shown a higher percentage of positive information ratio compared to large or mid-cap funds over when we talk about 3 years or maybe 5 years also. Why do you think that happened?
I think again, very good observation. So why the large cap and mid cap have not been able to have a very positive information ratio with respect to other categories, because the
Mm,
flexibility with the fund manager is very less within a large cap or a mid cap. Because in a large cap fund, 80% of the money has to go to the top 100 stocks. Now, how much
right.
different strategy or a risk a fund manager can take to generate that excess returns? And that is also the reason that these funds have not been able in a 3 or 5 year able to give a positive alpha or a higher alpha compared to the other categories. Like the other categories in a 3 or 5 year period would have given anywhere between 2 to 5%, whereas a large cap category has given about 1.5% over and above the benchmark. So, firstly, the excess return itself is less. And
Mm,
the risk obviously will be different, because you have very little number of strategies to play with, since your universe is so small. While in a small cap, for example, anything beyond 250 stocks is all small cap, or in a flexi
mm,
cap they can invest across market caps, so various stocks or various strategies can be applied. So the fund manager has the ability to go outside of the benchmark and
mm.
take active weights outside of the benchmark or some other strategies, basis which then the information ratio can be captured.
Okay. Let's also talk about how one can, understand using information ratio with other metrics like you mentioned beta, alpha, and also the Sharpe ratio, especially when recommending funds to clients. What is the thought process that goes behind this entire ecosystem?
So, see, nothing can be looked in isolation. This is one of the
Mm,
measures to measure the capability of a fund manager to give you a consistent and more efficient return on a risk-adjusted basis. So,
mm,
information ratio, like I said, is comparing itself to benchmark. and how much more risk it has taken than benchmark, or less risk is taken to benchmark to give you that excess return, right?
mm,
Whereas every other matrix, for example, like I mentioned to you, Sharpe ratio is not comparing it to the benchmark, but is comparing it to a risk-free rate. Or if you look at things like beta, beta is something which will give you the sensitivity of the fund with respect to its benchmark, which means that how aggressive or how volatile the fund has been with respect to the benchmark is what beta will
mm,
tell you. Whereas information ratio will not tell you how aggressive, or it will just tell you how much risk, more risk or less risk is taken compared to the excess return. So nothing can be looked in isolation. You have
mm,
to use all these, of course, measures to come to a conclusion that which could be a better fund manager. All I'm saying is that at least I should be aware of it,
mm,
the information ratio, so that I can give a little bit of better application of mind to when I'm choosing a fund manager. There are other ratios like Sortino ratio, which only look at downward standard deviation, which means only how the fund performs when the markets have always
mm.
been negative. So if it is drawdown is lesser than compared to the market, then those funds are better. But so all of it in isolation cannot be taken. You have to take it together and
Mm.
set your parameters to choose it. Information is ratio is one of the ways, and to evaluate a fund manager.
All right. One more follow-up question that I have related to IR is that when we talk about P ratio or other ratios, we do have some kind of parameters to compare it with. So how does a person who doesn't have any knowledge about uh, technical ratios in the mutual fund or maybe the markets, how can that person understand that this is the number is right for that particular fund or not? What is the way that a person should look at IR ratio? What is there any standard that one can compare it with, or how does it work?
So, like I said, Neha, firstly, the information ratio is all part of your fact sheets. So it's not that I
Mm,
need to compute it to see it. You can, to compare
yeah.
two funds or two fund managers, you have to just look at the information ratio in the fact sheets.
Mm, mm,
Now, within that also, in each categories, then you can compare it to your category average. That for that category
okay.
average, what has been the information fund match? So for, let me give you an example, like Anand Rathi, when we recommend funds, we also look at
Mm,
information ratio. So for the focus categories, we have recommended something called as ICICI focus fund, right? ICICI Pro focus
mm,
fund. Now, last 3 years, the information ratio is 0.9 versus its
mm,
category average of 0.07, which means that our the iPro fund manager is a better fund manager compared to the
yeah.
category average, because it has taken lesser risk to give you that excess return.
Mm,
Similarly, if you look at the small caps, also we have recommended Invesco India Small Cap Fund, which has an information ratio of 0.5 compared to its category of small cap is 0.1. So the more
right.
positive the information ratio is, it'll at least give you a sense to read it
Mm,
that I need a better information ratio to select the fund. Again, a small disclaimer: you may or may not use it yourself as an investor,
mm,
but can I ask
mm,
my advisor that have you looked at the information ratio? But I can only
mm,
do that if I understand it a little bit in basics. You
yeah.
don't need to really be knowing everything. Like I said, the more positive it is, better risk for you. That means the fund is taking lesser risk. If we just learn these concepts in a very basic manner, we'll be able to at least evaluate your advisor and basis which their selection.
All right. Let's also talk about some limitations of information ratio or the risks of maybe, over relying on IR. What's your take on that?
Yeah, so I mean, of course, like I said, this is not the only parameter when you're choosing a
Mm,
fund.
mm,
There is a process out there where you actually go out and choose funds. First, we need to be really clear about what kind of market cap allocation I want to give to my portfolio. Then you
mm,
need to look at each categories and see which are the funds have the possibility of giving you excess return. Once you give those excess returns, then you obviously apply all these statistics, like I said, beta, information ratio, so on and so forth, and then come to a conclusion that what could be the right funds
mm,
amongst the 500 open-ended funds today we have in the country, right? So it's a filtration process, but for you to understand it, and at least in terms of basics, will be very helpful, so that you know that when you're making that decision, you're making the right decision. and you're looking at all these parameters. So can't look at it in standalone basis. You can't be over
Mm.
dependent on this. Just because the information
Okay.
ratio is positive doesn't mean you select that fund. But
Mm-hmm.
is it one of the indicators? Yes. So that is something that you need to keep in mind.
All right. So before we close our conversation for today, one last thing I want to discuss with you is about SEBI pushing, greater fund disclosures and transparency. Do you think that information ratio should be a more prominently reported metric when it comes to fund fact sheets?
Absolutely, Neha. I think these fund fact sheets have so much information in that, but
Hmm.
unless it's made popular, we are just going to be dependent on someone advising us. If we look at the
Hmm.
fact sheets, if we look at those all those concepts and just understand it in basics, it will really help you to evaluate firstly your own advisor, and then of course if he's applying all these things, then he'll be able to give you a better fund with a high probability of giving you a better risk adjusted return. So all these things are there. Like you rightly said, it's very important for the regulator to make it more popular,
Hmm.
educate the investors so that they make a more informed choice.
All right. Well, this marks the end of our segment for today. Thank you so much, Chirag, for taking out time and joining us today on ET Markets Live and also decoding everything related to information ratio for us and also our viewers.
Thank you, Neha. Thank you, Neha. Always a pleasure.
Thank you so much. Thank you, everyone, for joining in.